This is a FarmDoc Daily webinar. I'm University of Illinois Extension's Todd Gleason, your host for the day. This one, Profitability and Conservation Practices, Results from PCM, the Precision Conservation Management Program. Coming up over the next hour, the folks from the Illinois Corn Growers, the Illinois Soybean Association, PCM, and University of Illinois will take you through a PowerPoint slide, starting with Greg Goodwin. He is with PCM. Good morning to you, Greg. Thank you for being with us. I'll get out of your way at this point and let you get started for the day.
Excellent, Todd. Thank you, and thank you to the whole University of Illinois FarmDoc team for hosting and producing the webinar. And good morning to our crowd here today, and thank you for joining us. As Todd mentioned, I am Greg Goodwin with the Illinois Corn Growers Association and the director of the Precision Conservation Management Program. PCM is a by the farmers for the farmers service program that currently works throughout Illinois and parts of Kentucky and Nebraska with approximately 500 farmers on about 500,000 acres. And today we'd just like to provide a brief introduction to our program and what we're all about. So here at PCM, we work to aid farmers along their path to conservation adoption and approach this in a variety of ways. We help farmers to understand how conservation practices impact their farm and net returns, help them to understand how they are addressing water quality concerns and working to prevent agricultural regulation, and by helping farmers to position themselves to benefit from positive conservation outcomes. So how do we do all this? We do this by trying to address precisely what growers are looking for when thinking about adopting conservation management strategies on their farm. And we do this through one-on-one technical support through our precision conservation specialists, a data collection platform to streamline data entry, ensure consistency and accuracy, as well as ease farmer burden. And annually, we provide a resource analysis and assessment plan, or RAP report, which includes economic cost tables, environmental assessments, and local practice comparisons to help farmers see how their management adoption approaches compared to themselves through time, to others taking similar management approaches, different management approaches, and how they compare against other farms of similar land types and at a regional scale. And so, as we know, your time is very valuable. We offer participation payments of $750 just for signing up and entering your data. This is split across 2 years, $500 at sign up, and then another $250 after 12 months in the program. And we also offer access and assistance with enrollment into exclusive programs that provide incentives or cost share for conservation practice adoption. And we offer networking and peer-to-peer education opportunities through field days and other similar events. And so just to give a bit of background about PCM and kind of why this program was started, the PCM program was launched by the Illinois Corn Growers Association in 2015 through a Regional Conservation Partnership Program, or RCPP grant, through the NRCS for $3.5 million at that time. And this was done to help farmers address agriculture's contributions to nutrient loading into the Gulf of Mexico and help Illinois farmers work towards the goals outlined in the Illinois Nutrient Loss Reduction Strategy. And just as a reminder, as you can see here, the ultimate goal of this strategy is for a 45% reduction in total nitrogen and total phosphorus losses by 2035, with an interim goal of a 15% reduction in nitrate, nitrogen, and 25% reduction in total phosphorus by 2025. And for those who may not follow these reports very closely, we have a long way to go in terms of hitting these goals. And as we all know, 2025 is right around the corner. So to provide some context to our current footprint and size of our team, we currently have 10 full-time conservation specialists who work directly with farmers in approximately 30 counties in Illinois, 10 in Kentucky, and 6 in Nebraska. And like every successful program, this one would not be successful without the help of our amazing partners. Specifically want to point out the Illinois Soybean Association, who came on as an equal funding partner to Illinois Corn in 2020, helping to provide additional technical support and direction to the program, primarily through their agronomy team and specifically through the help of Megan Miller, who's with us in studio today. And in addition, we have also been successful due to our corporate partnerships, such as the one with PepsiCo And as of this July, Walmart has also joined this collaboration to help us offer custom incentive programs to provide assistance to farmers for conservation practice adoption. And in total, you'll see here on this slide, we've got over 30 partners on this list, all of who have either committed cash resources or in-kind match to our federal grants. Unfortunately, don't have the time to mention them all, but could not be successful without them and cannot thank them enough for providing their support to farmers through this program. And so here, just wanted to take a quick minute to remind everybody also about our business case for conservation. This is our annual publication that was released back in June that goes into a data insert into the Prairie Farmer magazine. Please check it out. And if you did not get a copy, please let us know and we can point you to a digital resource. And I believe this is also in the additional data packet that's provided along with the webinar. So we'd also like to just take a quick moment to point out a couple incentive programs that we're a part of through the USDA Partnership for Climate Smart Commodities grants. One opportunity will be administered through Field to Market, who's a critical partner for PCM as well, and help to support the work we are doing with PepsiCo and Walmart. And the other is an opportunity to work with Farmers for Soil Health. So I'll quickly highlight the Field to Market incentive program. This program is helping us to offer pay for practice incentives to farmers for no-till or strip-till, cover crops, and nitrogen reduction to university recommended rates in exchange for the carbon reductions associated with those changes, which are claimed by PepsiCo and Walmart. As you will notice, there are payment offerings for single and practice combinations for both new and existing practices. Won't get into all the details of this today, but if you are interested and live in a PCM region, please contact us with any questions about this program. Our specialists would be happy to help walk you through that. The next opportunity is with the Farmers for Soil Health. This program offers an incentive payment for farmers interested in planting cover crops. This is a 3-year program paid according to the rates on the slide and only has a 1-year look back period. So if you did not previously or plant cover crops in the fall of 2022, you would be eligible for this new acre payment per year. And this is a statewide program, and you can learn about this through the Farmers for Soil Health website. PCM is going to be the technical assistance partner for this grant, so that will direct you to us and we can answer any questions you may have. And so with that, I will turn it over to Gary to launch our first poll question.
Yeah, thank you, Greg. And we have our first poll question here, and Jim now has it up for you. We're going to ask, select one of the following. Have you tried cover crops? And the alternatives are no, yes, next crop will be soybeans. So this is planting cover crops and then going into soybeans. Yes, next crop is corn. And if you've done both, then that's the fourth one. And then if you're not a farmer, the fifth option is the one that you can click. So we're going to get a feel for where our audience is at here, and we'll probably have a lot of people that aren't farmers. So we'll see where this all ends up. Again, what I'm going to do here next is talk about our cover crop results from PCM, and we're going to close the poll here, and we'll give you the results as soon as I can see them here. So here's what we find. 52% of you are not farmers, so 50% are. Of those that are not are farmers, 18% haven't tried them, 6% on soybeans, 8% on corn, and 17% on both. So that's actually more than I expected. So there you go. So let's talk about cover crops. I'm going to divide this up into soybeans and then corn. So we're going to talk about what we're finding out in PCM for cover crops on soybeans and corn. And we're going to start here. We now have results from PCM going from 2015 to 2022. So we have 8 years, if I can do the counting right. And in those 8 years, on soybeans, there's 3,750 fields that did not have cover crops, 918 that had overwintering, and we're going to spend most of our time talking about those, and then 33 that are winter terminal, which happened to be more related in the early years of the program. If we look at these two no cover crops and winter crops, we see 70 bushels per acre and 68. And we're going to find out later that when we do a statistical analysis, there isn't a statistical difference here. And I'll explain a little bit more why, but part of that is because the overwintering cover crops are done on no-till land, which does have a bit of a yield discount. Same soil rating, gross revenue here, a little bit lower for overwintering, again, because of that yield difference. And I would note here, when we're looking at gross revenue, we are not taking into consideration the incentive programs that Greg just mentioned. So this is without incentive program. So if we put an incentive program of $25 in there or so, you can see that these will come out about even. Non-land cost a bit higher on overwintering cover crops. And the reason why they're higher on the overwintering cover crops, if you're dividing those out by cost, direct costs are about the same. Power costs are a little bit higher for cover crops. Overhead costs are the same, but it's this $24 associated with the cover crop seed and planting. And if you think about it, if we put $24 in there and we don't reduce cost and we have a bit lower yields, then we're going to have a bit lower returns. We'll come and get back again to that point because we divided those farms out into those that were more profitable with or fields out that were more profitable with cover crops and those that weren't. And those that were more profitable had lower direct costs. So somehow, some way, they got their direct costs lower, and in particular on their herbicide area. Again, we'll come back to that. We're talking about cover crops, but you have a difficult time splitting those out with tillage because most of our cover crop farms tend to be no-till. And by the way, no-till also happens to be the largest number of fields in our data, 2,284 versus the next one, or one of the next highest one, which is one pass light tillage, $751, or 751 fields. 68 bushel yield no-till versus 70 bushel one pass light, just to make a comparison here. There is a statistical difference here. No-till has a bit lower yields than most of the tillage passes, and there is a tillage premium, or tillage does, in our data set, increase yields. Again, costs are about the same here between no-till and one pass light. Breaking that out a bit, again, no-till versus one pass light, and for some reason our strip till on our soybean fields have higher total direct costs, which include fertilizer, pesticides, seed, cover crops, seed, drying, storage, and crop insurance. And that is one of the things that we're working on, trying to figure out why those farm fields would have higher direct costs. In any case, when we did a statistical analysis of this, and we broke this out in more detail, and actually it was Sarah Sellers who did this in a dissertation, what we find when we look at these soybean fields is later planting date reduces yields, and by the same way reduces returns. So as we plant later, and most of our fields started in April, later planting did have a statistically different or lower yields. Cover crops did not have an impact on yields. However, it did reduce returns in the total amount, and it reduced it by about $30, which is more or less the cost of the cover crop itself. We did find that no-till has lower yields, but no-till did not necessarily have lower profits because it did reduce one tillage pass. But we did find that as you did more and more tillage, you did did tend to reduce returns. And by the way, we also included weather in here, and it did have a big impact, and we probably we'll talk about that some other time. When we divided those soybean fields out, into the most profitable 25%, and then looked at what those farmers did on those fields compared to those that didn't. Cereal rye was the number one soybean cover crop, or going into cover crops. By the way, that's also true of everybody practically these days. So even the low 25% also did that. Barley was our next cover, none. Of those that were in the 25%, drilled was the number one application system by a pretty far margin. The second was broadcast with the fertilizer, and then one till pass. And if you think about those two, this drill will have one cost, and one till pass will also have a cost. What we did find was that those that had overwintering cover crops that were in the top 25% did have 25 per dollar acre less in pesticide cost. I took this to believe that somehow they used the cover crop to reduce their pesticide application, and it's not exactly clear yet how they did that. Some of that was a reduction in pesticide applications. Some of them did plant green into it, some others didn't. So we're looking through that yet and don't have that teased out. And they did have higher yields. But if you're looking at soybeans as sort of a tried system, is cereal rye drilled is the number one broadcast with fertilizer and one till pass, and then looking at ways of reducing $25 in pesticide cost. I would note that when we're looking at these the previous returns, we did not consider the incentive payments associated with cover crops. Moving on to corn, we have far fewer corn fields triangle with corn. We did find lower yields in these overwintering fields, and for whatever reason, higher costs. So we did find that operator and land returns did go down. Again, this operator and land returns is what's left to pay farmer and landowner, and we did not, again, include the incentive payments in there. Just a point here, we did look at these across tillage classes and then look at the fields that were most profitable. We did find one pass light, no till predominated, but there was other tillage systems. This is agriculture, so you can never say never, I guess. When we look at our corn statistical results, we see that later planting date does again reduce yields and reduce returns. By the way, soybeans was more pronounced than corn. Cover crops had no impact on yields when we again controlled for tillage, but it did reduce returns. We did find that two tillage pest systems had positive impacts on yields, but no impact on returns, because by the time you include the cost of the tillage, it didn't cover its cost. Above MRT and nitrogen rates, and Laura's going to talk about those next, did increase yields, but it had no impact on returns. Finally, corn after corn did reduce yields. MRTN, by the way, is the maximum returns in nitrogen, which Laura will talk about more now.
Thank you very much, Gary. So yeah, I'd like to take a little time now and take a look at the precision conservation management nitrogen analysis, and then some of the impacts from our conservation practices that the PCM farmers have been adopting over the past several years. So I'm Laura Gentry. I'm the Director of Water Quality Research with the Illinois Corn Growers Association. I've been with PCM since it started, and I get to play with the data along with Gary, and we get to do a lot of these data-driven analyses that we get to share out with you all and hopefully give farmers more confidence as they are making informed decisions and financially based business decisions about their conservation adoption. So starting out here with our financial analysis and specifically looking at nitrogen fertilizer timing. And as we're doing that, let's take a look here at our categories. We have got 5 classes of fertilizer timing that each one of our corn fields falls into. And right now we are focusing on our higher productivity soil, so everything with an SPR, soil productivity rating, over 130. And we are looking at all 8 years of the program. So this does include the 2021 and 2022 growing seasons, which we know had historic increases in nitrogen fertilizer prices. So we will see the year-over-year impacts of that here in another couple of slides. It's very interesting. But our 5 classes of timing that we are going to look at are nitrogen applied in the fall. That means that more than 40% of the total nitrogen application rate for that corn, that growing season, was applied in the fall of the year. The next category is mostly pre-plant. This does include nitrogen applied as starter at planting. The next class is mostly side dress. This means nitrogen applied after planting. Our third category is a little more nuanced. It means that the nitrogen was also applied in season, and it was roughly split 50-50 between pre-plant, starter, and side dress. And then finally, our 3-way split is another system that includes some fall, but less than 40% fall nitrogen application. And then the balance of it was split between pre-plant and side dress. So those are our categories. I'd like to take the next opportunity to take a look at the number of fields. Let's see how our fields break out. And we like to show that the number of fields here, the greatest number of fields in our system is the farmers that are applying nitrogen in the fall, mostly in the fall on these high productivity fields in Illinois. Next ones are split about equally between pre-plant and side dress, with fewer numbers here of the 50-50 and the 3-way split. Next thing I like to look at is our nitrogen rates that go along with these timings. And what we see here are, this is the number or the pounds of nitrogen for every bushel of corn that was harvested. And so thinking about an efficiency value, a lower number here would be better. A higher number means that obviously the farmer had to apply more nitrogen to get that yield. And we see that the highest number here, 0.98, goes along with our mostly fall applied. Very simply, it's because farmers know they've got 5 or 6 months before the crop even starts taking up any of that nitrogen. So they're putting more nitrogen out there with the thought that they're paying less for that source because it's almost predominantly it's anhydrous ammonia. Other numbers are quite a bit lower. This 0.94 number is sort of in between with this 50-50 pre-plant and side dress. And then let's look at yields. The 2 highest yielding classes, as you can see here, are the 2 that have some fall nitrogen application, which is the 3-way split and the more than 40% applied in the fall. Those are our highest yielding corn yielding nitrogen timing classes. The lowest one here is the mostly pre-plant. So it's going to be interesting to see how yields balance out with our costs. So let's take a look at our nitrogen costs here. What we can see is that nitrogen fertilizer, farmers who are applying most of their nitrogen in the fall or some of their nitrogen in the fall are in the higher nitrogen category. The highest one, though, is right here in this 50-50 category because, as you can see by the nitrogen use efficiency value and the fact that farmers are applying a more expensive source of nitrogen, that's usually UAN, they are paying the highest amount of nitrogen per acre as just their nitrogen costs. Now let's look at these other direct costs. The 2 highest values here come from, again, the 2 fall nitrogen classes, the more than 40% in the fall and over here in the 3-way split. And that is largely due to the cost of the stabilizer that farmers are applying for their nitrogen, for their fall nitrogen applications. And we only apply that cost when farmers actually use stabilizer. We don't make some assumption that farmers are applying stabilizer. We only factor that in when the farmer reports to in the farmer portal that they use that. So we know that that's a $12 to $15 an acre added cost. So with all of that, we see that farmers for their direct costs are paying the most over here for our three-way split, followed up with our 40% or more nitrogen in the fall. Let's take a look quickly at fieldwork costs and other power costs. We see that farmers are paying, about the same amount for fieldwork for all of these nitrogen timing classes, a little bit more for the three-way split because there is that extra pass in the fall and again back in the spring. Other power costs, quite similar. Total power costs here you see are a little bit higher for those two fall nitrogen categories. Have a overhead cost that we apply uniformly across all these classes. And now what do we see? We see that our total non-land costs, all of our costs together, are the highest for the three-way split and the 40% or more in the fall. So the ones that have that fall nitrogen application have a little higher costs. So our question now becomes, the higher yields associated with these fall applied classes, are those extra bushels of corn that the farmers are harvesting are they paying for the extra costs that farmers are paying to make those extra yields? And the answer is, no, it's not. The answer is that actually the 218 bushel per acre average yield that's coming from our mostly pre-plant, a very respectable yield from these high SPR soils, but yet the lowest of the average yields in all of our classes here is actually the highest net revenue when you consider the direct costs, the power costs. So farmers are doing quite well if they sacrifice a little bit of yield, but they're also reducing their costs here, which is something I think Gary just showed us was also true for cover crops. So being able to keep costs down and yields high is really important and results in the maximum profits. So now let's move along here, and I move to thinking about nitrogen rates and give a quick call out to the University of Illinois' maximum return to nitrogen recommendation system. You can access that up here from you can just Google maximum return to nitrogen tool, and you can put it in your own data. You can put in what part of the state you're in and whether you're in a corn following corn or a corn following soybean rotation, and it will tell you what your recommendation is. And the results over the past, in 2022, range from about 158 pounds of nitrogen per acre up to 186 pounds of nitrogen per acre, depending on your area of the state, the cost you paid for your nitrogen, of course, and your rotation. I would like to mention, too, that the University of Illinois' recommendation system has successfully predicted the most profitable nitrogen application rate range every year of our program. So this is taking a look at nitrogen rates every year, as you can see, and it's for 5 different nitrogen classes. So we parse nitrogen out, the nitrogen rates out into classes ranging from less than 150 pounds of nitrogen per acre to more than 225 pounds of nitrogen per acre. And you can see the average for all years shown in by the blue line up here. And you can see that there is, there's a trend here. More that on the average, higher nitrogen rates have resulted in higher corn yields over time. That's probably not a great big surprise. The question, though, is, are the yield increases enough to pay for these higher nitrogen prices? So let's take a look at that. And what do we see? We see that no, on average, especially look at these giant jumps when we see these much higher prices in 2021 and 22 for nitrogen fertilizer. We also saw higher prices for corn in those 2 years, and we saw good yielding cornfields across most of the state of Illinois during that time. And so in 2021 and 2022, farmers who were applying less than 150 pounds of nitrogen per acre were the most profitable on the average. They had higher yields. They were saving a lot of money from for their nitrogen fertilizer costs relative to those farmers who are applying up here in the 225 or higher pounds of nitrogen per acre. And they had good yields because those were good, on the whole, good growing seasons for our farmers. Now, if you just wanted to see, though, on the average, looking at all of our data across all of our years, all of our growing seasons, which were quite different, we see that the most profitable nitrogen application rate range is in this 150 to 175 pounds of nitrogen per acre, which is consistently within our MRTN range. So farmers really need to be thinking about whether they are trying to maximize their bushels per acre or maximize their profitability. So that would tie up our conversation around nitrogen ranges, and would quickly like to talk about some of the practices that farmers are adopting in the PCM program, how that has changed in the last 3 years, and finally what that means for our impacts on water quality and on things like climate change and what we can do in carbon markets. So in the past 3 years, we see that reduced tillage acres in the PCM program have grown. We had about 235,000 acres of reduced tillage. That means no-till, strip-till, or one-pass light systems. Nitrogen management also increased a lot in the 2022 growing season. We think a lot of that is because of the growth of our program itself. We doubled the program in 2021 with the help of Illinois Soybean Association joining us as an equal funding partner. And we see also this big jump here in cover crops. The use of cover crops increased dramatically in 2022. And we know that this was in big part the result of these incredible incentives that we can offer to the PCM farmers through the help of our partners like PepsiCo and Walmart, and NRCS through the Regional Conservation Partnership Program. So we had over 1 million acres of conservation practices in total in our program over the last 3 years. So what does that mean for water quality and sediment loss? Well, if we look at this dark brown line here, we can see that sediment loss has dramatically been reduced as the result of these conservation practices relative to the 2020 and 2021 years. Phosphorus loss, we reduced over 165,000 pounds of phosphorus in 2022 alone. And look at nitrate nitrogen losses. We reduced nitrate nitrogen losses by over 1 million pounds of nitrate nitrogen per acre. I mean, not per acre, but per year in 2022. So that was really exciting. And we know that the practice that this is from all of our practices combined are these results, but it's really this increased use of cover crops that has carried the water in allowing our PCM farmers to make these dramatic increases in their sediment loss, phosphorus, and nitrate nitrogen loss reductions, and are really going to help our farmers across the state to meet the goals of the Illinois Nutrient Loss Reduction Strategy. So cover crops are such an effective tool in being able to help farmers with those reductions. So let's take a quick poll, and we would like to ask you, what value would you place on the soil loss or reducing soil erosion in terms of a dollar per ton value? Give you a couple of minutes there. Is it worth $5 per ton? $5 to $10 per ton? $10 to $25 per ton? More than 25, or $25 to $40 per ton, or more than $40 per ton? What would you place the value of your topsoil?
So we're going to figure this out by your poll. Are we going to present them some result of what happens next after this poll?
Oh, after the poll? Well, we're going to share it with you, but what we think that is sort of interesting about this is we are going to take a look next at what some modeled results would show are the results from the PCM farmers themselves, and what it looks like for tillage with corn, with soybean. How are things like reducing tillage really impacting soil losses? That'll be the next slide we're going to look at.
So we're going to close the poll here, and the answer is from our poll.
All right. Oh, look at that.
So we have predominantly in the higher classes there, greater than $40, 32%, 25 to 40, 30%, and then 10 to 25 is 20%. So
Jim Baltz won't let us participate in the poll, which we think is terribly unfair. But if we were allowed to, I would have gone with the greater than $40 per ton. What about the rest of you guys?
It's hard to put a dollar value on that. There's no market. Come on.
Ask an economist. Well, I'll just say that if you were just to replace just the value, just the straight value of having the soil brought back out to your fields, that would cost more than right around $22 per ton. And that is just the soil itself. It doesn't include the fertilizer or the other inputs that you're losing when you lose your topsoil. It does not include either the value of the improved water infiltration, the improved biological diversity, the improved soil tilt that you have. So if you put all that together, it's somewhere around $45 to $55 per ton is what a lot of researchers would indicate.
Okay.
All right. So let's quickly move on to looking at the results, the modeled results here by tillage class. And you can see these are our tillage categories: no-till, strip-till, one-pass light and two-pass light. That light tillage is like a vertical tillage pass. Moderate means it's one light pass and one heavier pass, and then anything else. And obviously, ahead of corn on these higher productivity fields, you are reducing your soil erosion per acre by about half using no-till or strip-till. That's really significant. And we see about the same thing really for soybeans. Big, big reductions by using these reduced tillage passes.
And obviously it increases as the more tillage passes we do because less cover, correct?
Correct. Yeah, that is correct. And how about the impact on carbon credits of using cover crops? This is something that we'll move right into with our next speaker, who's going to talk about carbon credits. Really important to note that you can really start generating some carbon assets by using cover crops and even by nitrogen reductions. So the orange bars here represent corn, the green bars are representing soybean. These are your average greenhouse gas emissions that are modeled through a tool that PCM uses called the Cool Farm tool. And on average, corn crops without a cover crop are net carbon emitters, meaning they have a net emissions of greenhouse gas emissions around 0.59 metric tons per acre. But farmers who are using a cover crop actually move into a net negative carbon emissions. And for soybean, there's a very slight net negative already because farmers are not using nitrogen, as we'll see in the next slide, which is has a very big carbon cost. But when farmers use a cover crop ahead of soybean, they really are a carbon sink, and there is value in that carbon sequestration that you are generating with your cover crops. And then speaking of nitrogen, I will also put in a note here that just really demonstrates how much greenhouse gas emissions can be reduced by reducing your nitrogen application rate. So for farmers who are applying up here in this more than 225 or really just even more than 200 pounds of nitrogen per acre range, if you are willing to reduce your nitrogen down into that MRTN range, you are also significantly impacting and having a positive impact on reducing greenhouse gas emissions, and there is value in that as well. So this is a great time to turn it over to Megan Miller to talk to us about carbon emissions and carbon credits.
Thanks, Laura. Excuse me, I really appreciate the opportunity to speak about carbon and carbon credits today. I'm Megan Miller, and I'm the Agronomic Programs Manager for the Illinois Soybean Association. And I'd like to start out this section of the webinar by launching a poll. Have you been approached by a carbon market? 1, are you already enrolled in a carbon market? 2, have you been approached but not enrolled? 3, have you not been approached by a carbon market? 4, are you not interested in carbon markets? Or 5, are you not eligible or not a farmer in this case? So we can go ahead and get that rolling, give you a couple of minutes to answer that. All right, I think we can go ahead and close. And so it looks like, again, about 50% of our viewers are not farmers themselves. 6% are already enrolled in some sort of carbon market. 14% have been approached and 25% have not been approached. And then another 6% are not interested. So a pretty big range across the board there. So we will go ahead and get into how these work. So in the last couple years, a lot of countries and companies have committed to carbon negativity or carbon neutrality. In particular, one of PCM's partners has committed to a 40% reduction in their Scope 3 emissions by 2030. And I know I just threw probably a lot of new terms at you, and by the end of this section, I hope you're able to understand or delineate what that means. So the next few slides will focus on the difference between Scope 1 or Scope 3 emissions, but in case anyone's interested, Scope 2 emissions are basically from powering your farm or your factory, depending on who's emitting the carbon there. So for a farmer, there are two really different ways that look pretty similar that they can enter a carbon market, but understanding what type of market you enter is really important for understanding who your partners are, who the end user of that credit is, and what your payment structure is going to be like as a farmer. So the first pathway is a farmer learns about a program and is willing to implement a conservation practice that reduces the production of greenhouse gas emissions or sequesters carbon in the soil. And we just heard about both cover crops and nitrogen reduction as it relates to the PCM data and how that impacts GHG emissions. The farmer will then complete enrollment, sign a contract, and begin implementing those practices. And to prove that they've implemented those practices, a farmer is going to provide data to that program. In the case of PCM, you would work with your PCM specialist to provide that data, and you wouldn't have any data entry to do yourself. So for the two pathways, there's an offset market or a Scope 1 market or an inset market or a Scope 3 market. And so the offset market is Scope 1, and this means the end user of your carbon credit is outside of the carbon value chain. So you would make a practice change, provide your data to your project manager, and they would sell that credit to someone outside of the carbon value chain, such as Delta Airlines or the Boston Consulting Group have bought these types of credits. There's also an inset market where, again, farmer makes a practice change, provides that data, and a agricultural end user receives those reductions for those credits that are generated by the farmer. And that can look a couple different ways. So that can either be practice change that you would get a premium for. You could get a premium per unit of grain sold, or they would calculate your outcomes. Yes, so we have a question from the audience. Some of us are not eligible for some carbon programs because they want additionality or new practices. So people already doing no-till or cover crops are not eligible to participate. Yes, you do bring up the principle of additionality, and there actually are, there are opportunities available through PCM for people that have done past practices. And I would also encourage you to do a small practice change. If you've just been planting cereal rye and you want to add some species diversity to that mixture, that would be enough of a change to get you in the market as well. So one question I get a lot about from farmers about entering these carbon markets is a lot of businesses and companies are being called on to reduce their greenhouse gas emissions. And so if they sell their carbon credits and they get called on to reduce their greenhouse gas emissions, what happens? And we need to remember that row crops are ingredients sold by small businesses, you as farmers, to publicly traded companies. And so that means if you sell your carbon to an end user who is in the agricultural value chain, you are basically just reducing the carbon intensity of your grain. That is the product you sell, and you have reduced your carbon emissions associated with the production of that. Now, if you have sold that outside of the value chain to Delta Airlines, you have then kind of lost continuity of that credit at that point. So, and the other reason this is important is I said earlier that PepsiCo, wants to reduce their Scope 3 emissions by a certain percentage. They are a publicly traded company and so are regulated by the Securities Exchange Commission, or the SEC, who has been trying to figure out rules to make sure greenwashing isn't occurring. And so, that is still under a comment period, but we could potentially see some ramifications of that going forward. Yes, so greenwashing would be basically saying that, claiming that your product is a certain amount of sustainable without having the information behind it to show that. So So recently, the Illinois Sustainable Ag Partnership worked together to do an analysis of all the ecosystem service markets available in Illinois. There were 3 payment types. You can either get paid for practice, paid for outcomes, so per tons of CO2 per bushel, or you can get paid just as a premium per bushel. So there are 15 of these available in Illinois with all different types of payment structures. We did ask all 15 of them what their enrollment in Illinois was. About half of them declined to answer, but we're looking at about 760,000 acres or 2.8% of Illinois farmland enrolled. As I said earlier, there's different payment structures for all of these, but we're averaging $19.27 per ton of CO2 sequestered in the soil. And so if you go back to some of the earlier slides, we are starting to build up some of the prices for cover cropping and no-tilling. That being said, there is still a bit of a gap there. So these markets are really here to reduce your risk and not pay entirely for the practice. So the federal government is also getting involved in this and started what they called their partnerships for climate smart commodities. And they funded $3.1 billion in projects across the nation focused on developing markets with climate smart practices. So things such as cover cropping, no-till, and reducing your nitrogen when it comes to row crops. 23 of these projects will be available in Illinois, and depending on what type of operation you have, there probably is a project for you. There are row crop projects, specialty crop projects, forestry projects, and livestock projects. All the projects funded were multi-state projects, so Illinois is a piece of the pie. Across all the projects available in Illinois, we're looking at $844 million. And if you just divide that by the total number of participants in each project, you're looking at around $45 million, which if you divide that further by the amount of acres in farmland, there's really about $2 an acre available to farmers in Illinois through this opportunity. And I think Greg did some back of the envelope calculations last night, and about 1.5% of the total funding for this is projected to end up in Illinois itself. So, looks like a lot of money, but you divide it by the amount of land in the country and it starts dwindling down pretty quickly. So we've developed some tips at PCM and the Illinois Soybean Association and ILSOY Advisor to prepare you for market enrollment. And the first thing I would always say to you is understand your conservation goals. Are you focused on nitrogen reduction? Do you want to reduce erosion? Because carbon markets may not be the best financial mechanism to help you achieve your goal. Maybe you just need a cost share program, but always lead with your farm's personal conservation goal. A lot of these companies are, especially on the carbon market side of things, are in a startup phase. And so it's probably too early to enroll your whole farm. Some of these contracts are pretty long and you want to make sure that that company is going to be there by the time your contract ends. Always be prepared with good conservation agronomy and find a good conservation agronomist to help you with your transition into conservation agriculture. We have access to those through the PCM program, so reach out to your specialist and we can definitely get you some advice when it comes to implementing these practices for the first time. And finally, as I said, you're going to transact in these markets really with data from your farm, and having good records and data is the key to receiving the highest dollar for your work. If you visit ilsoyadvisor.com/carbon data guidebook, you can download this guidebook that tells you the types of data needed for enrolling in these markets and how you can organize them as well. And again, if you do participate with PCM, your PCM specialist would handle this for you, which is a huge service offered by the program. And finally, once you sign on the dotted line, you've picked a market, things to pay attention to as you're entering. One, pay attention to your contract length versus your land rental agreements. Illinois has a pretty high proportion of rented land, and you just want to make sure you're going to have access to that for the length of your contract. Pay attention to if you're entering an inset versus an offset market. These have some implications on pricing and also who you're partnering with. And so just make sure you know and ask that question when you enroll. Also, pay attention to the fine print of your contract. Do you have a tiling project, for example, prepared for or planned for that piece of ground in the next couple of years of your 5-year project? Well, as soon as you dig the hole for your tiling, you have released a lot of carbon. And so just do some long-term planning and pay attention to the contract fine print. Also pay attention to how these carbon markets will use your data. Some of your input providers do have these carbon markets as well, and you want to make sure that they're not using your data to market a product back to you. Perfect timing. So we got a question from the audience about, is there a concern with modeled carbon versus measured carbon? Yes, and that has to do with kind of how it's verified. So right now, all of these markets are modeling the amount of carbon you sequestered. There is no way these markets would be profitable for either the market organizers or the farmers if soil was sampled across the country. And so we have to rely on these models in order to make that happen. And there is work going on at the University of Illinois with Dr. Andrew Margonaut and Dr. Kai-Yu Guan to start truing up these markets. So, but that's why you have to provide all of your data so they can run those models. So some markets will require a receipt audit. They'll visit your field. As I said, everything is modeled, and then satellites are also common. And then also pay attention to whether enrollment excludes you as a farmer for participating in other markets or government programs. You cannot sell a carbon credit twice, so you couldn't enroll the same piece of ground in both an inset and an offset market at the same time. You also cannot be paid by the federal government for the same practice on the same acre twice. As you saw, there is that $3.1 billion infusing the market, along with some funding in the Inflation Reduction Act. So just pay attention to the source of funding when you're signing your contract. And again, many non-governmental cost share programs are now associated with the carbon asset. PepsiCo has been a long-term supporter of the PCM program. And as they have had to make emissions reduction promises to their shareholders, that has kind of changed the relationship with PCM. And this has happened with other groups across the state as well. So programs that you were typically used to seeing as a cost share now have a carbon asset associated with it. And again, you cannot sell that twice. So and now I will kick it back over to Gary to wrap us up.
Yeah, is Todd here?
I am here indeed. You bet. I've been paying attention all along. We do have a couple of things. If there are some extra questions, and I don't see that there really are, but if they do come in, Gary and company will answer them.
If you have any more questions, be sure to answer them, because we did our job. We're getting you done close to time. We're proud of ourselves here. So
indeed they are. Hey, the other people that we're very happy with are the sponsors of the FarmDoc team. They include the TIA Center for Farmland Research, Compeer Financial, Corteva AgriScience, Farm Credit Illinois, the Corn Growers, the Soybean Association, and FS Growmark in the state, and of course our educational partners, which include FBFM, that's the Farm Business Farm Management folks, U of I Extension, and the Department of Agricultural and Consumer Economics right here in the College of Agricultural, Consumer, and Environmental Sciences. Of course, we do thank you for joining us today. If you want to see this again, you can always see it on the FarmDoc Daily website. You can scan that in, but there's going to be one more that comes up I think will be more important for you in just a moment. There on the FarmDoc website, FarmDoc Daily, you'll also find a link to the YouTube 5-minute videos, or you can just use youtube.com/@FarmDoc. I think that's @FarmDoc video if I remember correctly. And then finally, there's precisionconservation.org, that last segment. We'll leave that up for a bit so that you can get that scanned in on your phone. We do appreciate you being with us for the day, and thank you for taking the time to be here. If there are other questions, make sure you have them listed. I think there may be one last question, maybe two, that have come in. Gary, can you go through those very quickly?
Yeah. So the first one is, the PCM thinking about expanding into other state, or is there anything a state can do to requesting PCM to do work there? And Greg.
Yeah, happy to speak to that. So yeah, we really try to partner with local commodity organizations in whatever state that is. So yes, we are open to exploring opportunities in other states and discussing that. So if there's a specific request there or interest in a partnership, please reach out to us. We'd be happy to have a conversation about doing that.
So another question is, any chance carbon credit revenue will be treated as a capital gain and not ordinary income? And my answer to that would be no, because it is a payment. Having said that, I don't think there will be any cases of that, but maybe something happens in the future, but I would say no. So actually,
With that, we'll wrap it up. I think we're all done. Thank you to everybody who's been on line with us. You can again watch this later if you'd like. Search out the archive for the FarmDoc Daily videos. That's in the webinars section at farmdocdaily.illinois.edu. Our thanks go to our panelists today, including Gary Schnitkey from the University of Illinois, Megan Miller from the Illinois Soybean Association, Greg Goodwin, who is with PCM, and Laura Gentry with the Illinois Corn Growers Association. On behalf of Jim Baltz, who's behind the scenes and our technical director for the day, I'm University of Illinois Extension's Todd Gleason, wishing you a great morning.